So today we're talking about GameStop. Now recently Roaring Kitties put up a cryptic tweet saying that he's coming back or more like paying attention. So people took this as a sign that meme stock craze is gonna come back in season. And if you're one of these people, I can kinda understand why. Because you saw GameStop go from 77 cents over 100 times returns all the way up. I'll show you the chart in a bit. But this time has been really different. GameStop has rallied quite a bit and just come back down. So what happened? Was this time really very different? So before we get into that, I just want to explain a little bit about what a short squeeze is and why I think this time is so different and why so many people lost money. Hi, my name is Zach and I want to help you invest your money by showing you how I invested for me and over $15 million which I manage on eToro. So today we're going to talk about what is a short squeeze, where the price is gone, and why I don't think this season is really going to be exactly what people think. So let's get into it. So GameStop is a popular video game retailer that during the 2020 season, or the year 2020, there was this huge meme stock craze. And this was driven by Wall Street Bets, the popular Reddit forum. This had two implications. One was this dear brand that everyone loved in the States was going to survive. And two, down with the evil hedge funds. You see, because what the hedge funds were doing is they were shorting the position on GameStop, meaning they were borrowing shares from other investors, selling it in the market, hoping the price was to drop, and then buy it back at a lower price before returning it. Now this seems like really evil because what you're doing is you're hoping that the business is gonna go to zero. And because of this perception that hedge funds make a lot of money, and it's not a wrong perception, some hedge funds certainly do make a lot of money. And while Main Street really loses out because Wall Street is forcing these guys to go to zero, seems absolutely evil. So Reddit or Wall Street Bets basically looked at all these hedge funds who were shorting GameStop and said, hey, why don't we squeeze them out? By forcing the prices higher, you are forcing these hedge funds, instead of buying at a lower price, they have to buy at a higher price to return it to the people they borrowed it from at a premium, thereby losing a lot of money. A short squeeze really happens when everybody is forced to cover these positions which they borrowed because they have lost just way too much money. You can imagine, like, if someone put on a position that was just 10% of their portfolio, but GameStop rallied 10 times, they would need to cover. They would basically mean that they've lost their entire portfolio. Shorting is a very risky business. But what happened? This time around seems a little bit different, doesn't it? So as you can see from this chart, GameStop went from all the way 70 cents all the way to about $93 thereabouts. So that's a huge increase, more than 100 times. So even if you invested 1% of your entire portfolio in shorting GameStop, you might have lost your entire portfolio just on one trade. But what's interesting about 2020 that's so different from now is this. As you can see here, there's something called short interest, which basically means the amount of shares that are being shorted of the company. At the time, GameStop had a short interest from about 80 to 90% and even above 100% at some point. But fast forward to today, you can see that the short interest isn't what it used to be at just 21%. Even when the short squeeze happened last week, it only had about a 20% short interest. So clearly this time is really different. You're talking about 4 to 5 times less short interest in the stock now than there was in 2020. And that's why I think it's like a really bad investment. So unfortunately last week when the squeeze happened, it was at $17 and it rallied to about $50, $60, and now it's all the way back down at 22. So if you got in way before the meme, you may have been making some money. But majority of people who are chasing this trend would have lost money. So if you're wondering who made money, I always ask myself the question, who's the biggest sucker in this transaction? Well, Unfortunately, I think in this case, Roaring Kitties is definitely someone who made a lot of money on the back of his influence. And if you look at the Netflix documentary on meme stocks, you can see that he actually does know what he's doing. He is financially trained. Now, the second beneficiary of this meme stock craze has been GameStop itself, because as you can see from this article, you can see the company filed an offering up to 45 million shares, and the proceeds will be used for general corporate purposes and also investments and acquisitions. So what this means is that if you're a holder of GameStop, the company itself decided to issue more shares, so you're going to own less of the actual company itself. This means you get a smaller portion of the revenue, you're going to get a smaller portion of the business itself as a whole, as the company sells shares to raise more money. And again, this lets GME live on longer, but should really unprofitable business continue to run, and their CEOs and all their management continue to be paid high salaries? I don't have an answer for this, but I do know that the Wall Street bets community just thinking they're gonna screw the hedge funds by doing this is a very, very naive philosophy. There is benefits to doing short squeezes, and I believe that there should be every once in a while, because certain stocks shouldn't be shorted as much as they are. But should you keep running an unprofitable business continually with no room for improvement or no room for growth or runway? I think it's a bit risky. Hey, real quick, before we get to the next point, if you're interested in my portfolio, the link is in the description below. I show my entire portfolio and the way that I trade on eToro. Also, the sign up link is in the description below. Last point, as an investor, I don't ever want to depend on two things. One is luck and the other is timing. To make money on this kind of trades, which are very retail driven, you have to have both. If you're referring back to the Netflix documentary, if you watched it, you know that there are few characters in there who made a lot of money on GameStop, but have no financial experience and were just lucky. Diamond hands, as you would call it, right? But I try my best, especially for myself and my investors, to reduce as much of the luck element as possible, and also timing, because market timing generally is impossible if you look at statistics. So how do we do this, especially over a very long period of time? I plan on being here. I've been here for 8 years. I plan on being here for another 20 more. How do I do it? I find mispricings that I know can revert. And if you're interested in that, you can subscribe to the channel, because I'm going to have a lot more of that. And also real quick, if you want to check out my portfolio,